Could reaching peak ESG cause Vice stocks to outperform? A growing feeling that the industry is reaching peak ESG has prompted calls that the opposite trade, in beaten-up Vice stocks, is poised to outperform this year even as value continues to trail growth.Never has ESG been so ingrained in the investment industry's conscience. According to Morningstar data, investors are becoming more discerning in their responsible fund choices, with funds rated high on its sustainability rating experiencing consistent net inflows since 2017. During the past 3 years, an impressive £30 billion has flowed into these funds, compared with net outflows of almost £14 billion from funds rated low. See chart. In January, Larry Fink, chief executive of the world's largest asset manager Blackrock, used his annual note to investors to pledge to reverse the firm's track record on climate inaction. Fink said Blackrock will require companies to provide a plan for operating within the Paris Agreement's goal to limit global warming to 2 degrees. We will be increasingly disposed to vote against management when companies have not made sufficient progress, he wrote. Asset managers continue to be targeted for their role as investors in companies seen to be climate damaging. Last month, both Baillie, Gifford and Hargreaves Lansdown found themselves on the receiving end of Extinction Rebellion protests outside their offices over investment in fossil fuels. Against the flow such is the momentum behind investing in quality growth ESG stocks that Psigma Investment Management Chief Investment Officer Tom Becket has taken the contrarian view that beaten-down value stocks in controversial sectors such as oil, tobacco and alcohol could outperform in the year ahead. When we start hearing Larry Fink talking about what he did last month, as well as seeing signs that Wall Street sees this as the new opportunity to make money, this strikes me as being somewhat of an opportunity to do the opposite in the short term, and makes me want to take the contrarian side of the trade, he says. Despite a brief value rally in September last year, global growth has outperformed value over all time periods for the past decade, see chart below. The dispersion between the valuations of the two styles has never been greater. But Becket sees value stocks outperforming over the short term, especially in a world where growth sectors are loved and most sectors trade at near record valuations. The dislike and dismay hanging over tobacco and oil stocks could lead to outperformance, with valuations low and ownership minimal. He adds, if we are anywhere near right, and the biggest understated risk for markets is inflation, then one can make a case for commodities and gold companies to make headway in the months ahead. Financial as well as ethical benefits according to Morningstar Director of Passive Strategies. And for more on this story, visit the news article link.